more ado, if we go into the first item on the agenda, which is apologies for absence. Jeremy, are there any?
No, thank you, Chair. There are no apologies.
Thank you. So item 2 is disclosure of personal and prejudicial interests. And I'd like to declare an interest in all items on the agenda in that I'm in receipt of a pension from the fund. Shall we go around, first of all, members of the board, if anybody wants to declare?
Yeah, I've got a family member who's a member of the LGPS, so all items on the agenda.
Thank you. Oh, there was some loud noise there. Councillor Noyle.
Thank you, Ian. Yes, same as you. I'm a member of the local pension fund as well. Thank you.
Any other members want to declare an interest? No, I'm seeing nobody indicating. Rob, you're not a member?
Well, I'm an employee of Swansea Council, so by default, I'm a member.
Yes, okay. So I think that
based on that, Rob.
Fund.
Sorry, Chairman. But the legal advice we've had previously, Rob, is that you need to declare a personal interest.
Okay. Yeah, I'm a staff member of the authority, so yes, I'm a member. There we go.
But as well as a staff member, you're actually in the pension.
Well, it's automatic because you're in the pension if you're a member of staff. So
yes, well, unless you as unwise as to opt out.
Yeah.
Thank you, Rob.
Okay.
And I think that's it for members. Officers present.
Hi, Chairman. I'm a member of the scheme.
I'm also a member of the scheme.
Yeah, and myself, I'm a member of the scheme as well, Chair.
Thank you. Is that it for declarations of interest? I can't see on my screen anybody else indicating.
Yes. Yeah, that's it. Thank you, Chair.
Thank you, Jeremy. And so next item on the agenda are the minutes of the previous meeting. If people are happy to, we can go through these with matters arising and accuracy at the same time. Yes. So page 1 of the minutes. I haven't got you on my screen at the moment as I'm going through the PDF. So speak up if you want to say anything. Anything on page 1? On item 3 there, I don't seem to be down as having declared an interest. Unless I'm losing my memory, which is certainly a distinct possibility. I seem to recall I did, as it was my first declaration in receipt of a pension. Could the recording be checked there, Jeremy? And the
I can amend that, Chair. I can amend that.
Thank you. Page 2 of the minutes. I'm scrolling down. Page 3 of the minutes. And finally, page 4 of the minutes. I didn't hear anybody wishing to speak on that, so could I have a proposal there, a true record subject to the amendment?
I propose that.
Thank you. And anybody seconding?
Happy to second it.
I'm very grateful. Thank you. So anybody against? Any abstentions? And I'm seeing no indications on either of those. So moving on to, well, such as it is this time, to the breaches report, which is an information item. Jeff, you're going to take us through this.
Sorry, Chairman, there is an item before that. Item 4, the triennial evaluation training and update. We've got our esteemed guests online, Chairman, Laura Corwell and Eric.
How could I forget them? Item 4 is not in my bookmarks. But yes, welcome to our speakers. I think we've all met, certainly both our speakers before. So welcome to the Swansea Pension Board, and over to you.
Just by way of introduction, Chairman, if you could beg my indulgence. Obviously, we've invited Laura and Eric here to present to you, which they have done similarly for the Pension Committee 2 weeks ago. As you're aware, we're required as a fund to undertake a triennial evaluation. As the name suggests, every 3 years. That time has rolled around again, and obviously, just to remind you about the statutory and legal obligations around what a triennial evaluation is, and what the outputs and objectives of a triennial evaluation are. We've asked Eric and Laura to come along to give you a gentle reminder. I know you've had it in your formal training previously, and you had the pleasure of hearing Eric and Laura speak 3 years ago in 2022, but who can turn down the opportunity to hear from an actuary speak again? So we've invited them along again. They've been very generously given an hour to entertain you and inform you in the next hour. Please do make it interactive and ask them any questions. There will be a short exam at the end of it. No, joking. There isn't an exam at the end of it. But over to Laura and Eric for their training session. Thank you.
And thank you, Jeff. Eric, I think you're going to share the slides for us to talk through. So we've got the slides in, as this is a public meeting, we've got the slides in Welsh and in English. So if they look a bit small, I think you have if you're online, I think you can sort of zoom in to the side that you want to look at, and so it's a bit bigger. But so please do that. And as Jeff said, please do. Chair, if you spot anybody with questions, please just shout out at us, because we're looking at the slides, we may not notice if somebody's got a question for us. So as Jeff explained, we're here to give you some sort of training and a reminder on the sort of process around the valuations and the assumptions that we need to use when we're doing the calculations, and to kind of give you a heads up of what the 2025 valuation outcomes will look like. So a little bit of spoilers. We'll be back to see the committee, as Jeff said, in November. They'll be making decisions about the sort of final funding strategy, and all the final valuation results will fall out of that. So we've got a good idea of what the valuation results will look like, but we've not been through all the calculations for every employer yet. So we will have done that by the time we come back to see the committee in November. So yes, please do shout out with questions. Obviously, it's quite technical stuff that we come to talk to you about every few years. So appreciate you may want to clarify some of the things that we're talking about. So just the speakers. We've met us before, but just as a reminder, so I'm your fund actuary, Laura Caldwell. I've been working with Swansea Fund for many years. So I am a director in the public sector pensions team in Bristol, and Eric is also based in Bristol, and he's a qualified actuary in our public sector team as well. So, and also been working with the Swansea Fund for many, many years. So we both know the fund pretty well. So the next slide is just the agenda for it's a sort of training and information session today. So I'll go through the valuation process, and then Eric will talk you through what's happened since the 2022 valuation, and then things we need to consider for the 2025 valuation. Then I'll explain a little bit around the funding strategy and things that we in the committee will need to make decisions on for this valuation. And then we'll give you sort of a bit of a heads up on the 2025 valuation results. I'll finish by then just having a look at a few valuation sort of hot topics and what we're going to be doing in the next few months. So let's kick off with the recap of our process then. Just to remind ourselves what a valuation actually is. So first of all, it's really two jobs that we have to do. First of all, we will have a look at the past service position of the fund. So that is, we compare the market value of the assets the funds hold, and that's sort of what's put in your report and accounts every year at 31st of March 2025. And we compare that with a market value that we place on the promises that have been made to members up until the 31st of March 2025. So all existing members, actives, people who've deferred their retirement and have left, and current pensioners and dependents, all of those we put a value on their benefits and compare that to the value of the assets. So if the assets are higher in value than the liabilities, we say there's a surplus or that the funding level is over 100%. If the assets have a market value which is less than the value we put on the liabilities, then we say that there's a deficit or that the funding level is below 100%. So when there's a deficit, we need employers to pay contributions relating to their own individual notional funding level and any level of deficit they have. And the idea of that is that they recover their position to full funding over a suitable amount of time. And when there's a surplus, it may be that contributions are reduced to return that employer to a full funding position over time as well. So those adjustments to the contributions for the past service position are called the secondary contributions. So the other job that we have to do, as well as looking at the past service position of the fund, we also have to consider the cost of those active members still building up benefits today, tomorrow, into the future. So we calculate these costs as a percentage of pay, and the employer pays the total cost less whatever the members are paying into the fund. So these future service contributions are called the primary contributions. So when you add together the primary and the secondary contributions, we've got the total employer contribution. Each employer will have to pay their own contribution rate based on their own membership and their own funding position. In the end, the whole fund position is the sum of each of the individual employer positions. So we are required to carry out the valuation, including certifying all those employer contribution rates by the 31st of March in the year following the valuation date. So in this case, we have to finish everything off and sign everything out by the 31st of March 2026. Next slide, please, Eric. Thank you. Okay, so this slide is sort of picture demonstration of what a valuation is, really. So that past service position I talked about involves us having to add up all of the liabilities and put a value on those. So the way we do that is we look at each future year and consider the amount of money that the pension fund has got to pay out in benefits in each of those future years. So that involves considering current pensioners' pensions, how they're going to increase with inflation, how the pensions for their spouses will come into payment when they die, and it considers the future payments for any deferred members and active members. It only considers the active members' pension benefits up for the benefits they've accrued up to the valuation date. So as you can see, the chart, the cash flows that we sort of project into the future go many, many years, and we have to put a current value on those. So how much money do we have to have invested now to meet each of those payments in the future? So the sum of all of those numbers is the liabilities. In order to do that calculation, we have to consider the timing of each of these payments and the amount of each of those payments, and that requires a certain number of assumptions. So what assumptions do we need to make to calculate the value of in today's money terms, so we can compare it to the market value of the assets that we hold? And that's what this slide is setting out. So most of these assumptions are fund specific. So the assumptions we make for the Swansea Pension Fund would be different to assumptions that we'd make for, say, the Cardiff Pension Fund, or any other fund in England or Wales. So we consider the assumptions in two categories. The teal colour on the slide are the main financial assumptions that we need to make, and those affect the amounts of those cash flows that we talked about. And the grey bars are the demographic assumptions, which mainly affect the timing of the cash flows and how long they carry on for. So the main financial assumptions that have the biggest impact on the value of the liabilities are the discount rate and the future inflation assumption, because almost all the fund's benefits are linked to CPI inflation. The other really big and significant assumption is the post-retirement mortality assumption, or how long we expect people to live in the future once they have started taking their pension. So I'll just look at the discount rate and how we set that assumption. So the discount rate is really our estimate of how much the fund assets will deliver in returns for each year into the future. So the vast majority of your employers are long-term secure employers or have guarantees by such bodies or other organisations. So we can assume they're going to be in the fund for a really long time. So we can therefore base the discount rate or the investment return assumption on your long-term investment strategy. So what we do is our global asset allocation team, they look at each asset class and sets an expectation for future returns for that asset class and how volatile those returns are expected to be in the future. And those are called capital market assumptions. And we use that to set your expected return assumption, looking at what proportion you're expected to have in each of those asset classes in your strategy in the future. The calculations also give you credit for having a nice diversified split of different types of assets. But this isn't our sort of best estimate investment return assumption, which could have a 50% chance of being too high and 50% chance of being too low. We set an assumption which is more prudent than that, and that's what this sort of chart is showing you. So we set our discount rate to be much more than 50% sure that we'll have enough money in the fund to pay all those benefits at all those future dates. So that level of assurance that we want is what we call the probability of funding success. So at the last valuation, the committee agreed to use a probability of funding success of 83.5%. And as the fund is in a really strong position, as you'll see a bit later on in the slides, we're proposing to remove some more risk from that discount rate and increase the probability of funding success, this valuation, to 86%. So Eric will talk you through in a moment how our assumptions have evolved since 2022. So on the next slide, we just this is just to think about what else we need to take into account when carrying out a valuation for each employer. And these are like sort of the core elements of your sort of funding strategy when it comes to doing a valuation. So I've talked about the level of prudence in the assumptions. So all of our assumptions are our best guess of the future, apart from that discount rate. So that's the one where we put our sort of prudence in the discount rate. I've mentioned how we take account of the funding security of your employers, so that allows us to take a long-term view setting assumptions. You do have one employer who will ultimately exit the fund in the future without any sort of guarantee. So we take a more prudent approach to their funding position to protect all the other employers from the risk of having to pay their future costs when they do exit. But one key factor in how we deliver stability of contributions and help manage risk is how quickly we recover a deficit where an employer has one, and how quickly we decide to return surplus to employers through reduced contributions. Another key factor that we have to consider is, in order to deliver stability, is around the pooling of risks. So we have some employers in the fund who pay a common future service cost to help manage fluctuations in membership for those individual employers, because they're all really small, and they can have members coming and going, which can have a big impact on their costs. So we kind of group them all together and have the same rate. And we also have the option on your funding strategy of gradually implementing changes to contributions through steps. We typically do this when it's difficult to ask for large increases all in one go. It makes less sense when you've got a surplus and you're reducing contributions. But when we talk to the committee in November, we'll sort of be clear about where we think we should be on each of those, and the committee will be able to make a decision because they'll have the results in front of them. But Eric's now going to talk about a bit more on our experience since 2022. So over to you, Eric, unless anybody's got any questions in the meantime on what I've been talking about. No, I think you're free to go, Eric.
No, I thought Ian, you or Chair, you had a question maybe, or
no? I was just going to say I couldn't see anybody indicating that
right.
they had a question. So yeah, over to you.
That's okay. Thank you very much. Thank you, Laura. And so, as Laura said, I will now, in my short second part of this introduction, take you through the development since the last valuation. But before I do that, I would like to remind everyone what was the position at last valuation, so that we know the starting position, where we're starting from. So at last valuation, the fund was just over 100% funded and had very small surplus of around 3 million. Which, as Laura explained before, there was more assets than liabilities at last valuation. And just to remind everyone, this was based on the probability of funding success of 83.5%. And this translated to the overall contribution for the fund to be 21.3%. And this was composed of these two elements, as Laura explained, the primary contribution rate and the secondary contribution rate. The primary contribution rate, which is the cost of future benefit accruals, was calculated to be 21.3%, and that's just the element for the employers. At the whole of fund, so as Laura has explained before, this is the kind of average across the fund for all employers. Each employer paid slightly different contribution, and this was based on their membership profile and the funding target selected for them at last valuation. And the primary contribution rate for the employers at last valuations ranged from 18.1% to 40.8%. As overall, the fund was just over 100% funded, there was no secondary contribution, so there was no deficit to recover, nor any surplus to give away, or the surplus was really small. But because at last valuation, the committee decided to withhold some of the surplus as a security, and only the surplus above 110% funding was given away. The secondary contribution across the fund was 0%. However, again, across the employers, this varied it was quite a big range as well, depending on the position of each employer. Some employers been in deficit at last valuation, some employers been in a relatively high surplus, and the secondary contribution range from minus 24.6% to plus 23.3%, so quite a range, which resulted, as I said, in the total contribution across all employees for the fund of 21.3%. But individually for employers, the range was between 0% and 64%, so quite a wide range. And then the kind of the higher ranges, the 64%, was for the one employer which was on the orphan funding target. So this is the employer which is expected to exit the fund and then leave the liabilities behind without any guarantees. So we use slightly more prudent assumptions for that employer to ensure that the fund's got enough money going forward and that no other employer needs to find those benefits. Right, so that was the position at last valuation. So in terms of development since the last valuation, let's first look at what's happened to the assets. So this chart shows the returns by asset class for the major asset classes. And the chart is not representative of what the fund return was, and I will talk about that in a second, but it just shows you the progression of different asset classes. So as you can see, the equities, the UK equities and the overseas equities, these are the red and green lines on the chart. They started relatively flat, and then around middle of the period, kind of towards the March 2023, they started increasing and done really well and delivered quite a significant returns by the end of March at end of March 2025. There's a tiny kind of drop in the overseas equities at the end of March, and this is connected, as you might know, with the tariffs President Trump is introducing. But since, just to give you a bit of a heads up, the assets kind of recovered that little dip, especially the equities. In terms of the other asset classes, the properties, which is the gray bar, they started relatively well, and then they kind of started dropping and kind of delivered negative returns over the intervaluation periods. When it comes to the corporate bond, fixed interest yields and the index-linked yields, as we know, they kind of started a bit wobbly, and then after the mini budget, the yields on government bonds increased quite a lot, and this led to reduction in the value of the yields and therefore a negative returns for those asset classes. But as I said, the fund invests in a variety of different asset classes, and overall the fund performance over the 3 years since last valuation was 16.3%, which equates to around 5.2% per annum, which again is higher than our expected assumptions for the fund at last valuation of 4.1%. So in other terms, the fund performance was better than assumed, and the assets outperform our expectations. Right? Any questions so far on this, or is everyone all right? No questions? Good. I will then move on to the next slide and talk a bit about the inflation. So at last valuation, when we started doing the calculations, we kind of usually do them around June and then finish them around September, October. And at time, the expectation of the inflation was that the inflation will be going quite up and the increase in inflation will be quite considerable. And at the time of the valuation, we knew that the September 22 inflation will be kind of above 10%, and then that the peak will be kind of a carrying over for a short time, and then expectation was that the inflation will drop to the long-term target. And as you can see, the inflation, the pension increases in April 2023 was 10.1%. In 2024, it was 6.7%, and then this year it was 1.7%. So quite a big increase in inflation. And as Laura said, most of the benefits are directly linked to CPI. So increasing CPI directly increases the liabilities of the fund. As I said, at the time of the valuation, we kind of knew about this. And to countermeasure this high inflation increases, we've put a loading on the liabilities and we increased them by 10% to offset that high inflation, which we were expecting. The future expectation of the inflation, I think, is that the inflation will kind of, it's still relatively, maybe not relatively, it's slightly higher than the long-term target around, I think the August CPI inflation was around 3.8%. So it is above the 2% target, but the expectation is that in the long run that the inflation will drop. So we don't have similar concern, or we don't have concern as we had them at last valuation. So we're not going to introduce a short-term inflation loading because we believe the inflation will kind of drop to the long-term target. I've mentioned a bit about the yields, and as we know, the gilt yields increased quite a lot since the last valuation. The increase happened mainly after the mini budget in 2022. However, as Laura mentioned, the way we set the discount rate is not directly linked to the performance of the guilds. Instead, we look at the performance of all the underlying asset classes and come up with an overall expected return. So this had a bit of an impact on the discount rate we set, but it's not it's only kind of to the extent the fund invests in the guilds. However, this had quite a significant impact on all the employers which are valued using the low risk funding target or the orphan funding target, and that relates to that one employer which is expected to leave the fund. And the position for that employer, because of the increase in the guilds and the mismatch between the assets and the guilds, improved quite considerably since last valuation. Right? Moving on, so what does this mean for the key financial assumptions? So it's the discount rate, pension increase, and the pay growth. At last valuation, based on the probability of funding success of 83.5%, we set the discount rate to be 4.1%. As I said, the expectation of the asset returns slightly increase. And if we were to use the same probability of funding success at this valuation date, the discount rate would be 4.7%. However, as Laura mentioned, the results for the fund are quite good and the asset return were really exceptional over the 3 years. And therefore, we are in the position to increase slightly the prudence of the fund and at the same time reduce the contribution for the employers. So we propose to increase the probability of funding success to 86%, which results in a discount rate of 4.55%. In terms of the pension increase and the CPI inflation, at last valuation, our assumption was 2.3%. And that all was taking account some of the high increases, but on top of that, as I explained, we also put the 10% loading on the liabilities to counteract the short-term inflation. At this valuation, the inflation is dropping and the expectation is that it will drop towards the long-term target of 2%. So our long-term assumptions for the CPI is 2.1%. And what does this mean for the liability? To just give you a bit of a heads up, when we increase the discount rate, so when we expect the assets to deliver higher returns, the liabilities for the fund are lower. And when the CPI inflation is dropping, again, because it's linked directly to the liabilities, and if the inflation goes down, the liabilities goes down as well. So both of this resulted in an improvement or reduction in the liability, improvement in the funding position and a reduction in the liabilities for the fund. Right, moving on. Let's now have a quick look at the post-retirement mortality, which is the key demographic assumptions and has got the biggest impact on the liabilities. And this assumption basically tells us for how long the fund needs to pay the benefits to the members. So if we expect the members to live longer, that will increase the liabilities because the fund needs to pay the benefits for a longer period. If we believe the mortality reduces and members will live shorter, then that directly reduces the liabilities. So how do we set the post-retirement mortality? So in simple terms, there are two components to setting this assumption. There's the base mortality and the future improvement. The base mortality looks at the current experience of the fund, and the future improvements looks how that current experience will develop into future and whether members will be living longer or shorter. And to do that, we take into account the funds data. We look at the individual members' postcode data and we cross-check it with our database of all the other or kind of the key information we've got about the postcodes in terms of how long the members live in those postcodes. And then we use the standard models to fit or to come up with the best assumptions for your fund. And obviously, we use our judgment. So moving on to the base table, we use the latest mortality tables and then explain. We take the fund's experience and we try to fit it to the standard table. And so that's the first step. And on the slide, on the picture, you can see the distribution of all the pensioner members for the fund. You can see where they all live. And as you can see, the highest concentration is around the Swansea and the kind of nearby areas, with 10% of pensioners living somewhere else along the Wales and England. Moving on to so that was the base mortality table, which we use standard tables. In terms of the future improvements, we also use the standard models.
Sorry,
yes.
Eric. Just on those postcode indications, is that where is the postcode where a member, for example, spends most of their working life, or if a member retired somewhere salubrious, but had spent most of their working life in, say, a heavily polluted area, how does that work?
So in terms of the postcode we take into account is the current postcode when the member lives. And the main indication is maybe not the quality of the air, but it's more to do with the socio-economic status of the members and what they can afford. And then in terms of the what places they can afford indicate what kind of disposable income they have to take care of themselves, whether they can enough cash to go to the gym, whether they can afford kind of like private healthcare. So it's kind of more that indication instead of whether they come from very polluted area.
Oh,
So it's where they're living on the valuation date.
Yeah.
Yes.
Yeah.
I mean,
So your
I
pensioners,
appreciate that.
they are moving around after they've left work.
Yes, I was just thinking a lot of the impact on their health might have been suffered by then, but obviously postcode's a bit of a proxy anyway for health.
Yes, absolutely. And then if
Thank you.
a lot of people from those kind of areas move to a different postcode, then obviously the statistic for that postcode will change. So we'll then kind of take it into account, but it's a kind of long process and a lot of data, and it's a kind of moving feast. But because Swansea Pension Fund's got a lot of members, on average, the method gives quite a good results. And it's quite stable. Yep. Sorry, Jeff.
So sorry, Eric. Just for the chairman's benefit, correct me if I'm wrong now, Laura and Eric. I mean, as a cohort, LGPS members and pensioners fare slightly better than their counterparts who aren't members of the LGPS in a geographic region. So to your point, Ian, about, say, for example, Neath Port Talbot, Swansea, you know, the experience of LGPS active members and pensioners and retirees, etc., is slightly better than their counterparts who aren't members of the LGPS because of the reasons that Eric has explained.
Yes, I think that's fair to say. The one kind of bias we have, obviously, is that we've got access to the data, which is for members who have pensions. So that there is a lot of members which we don't really capture who do not have access to the additional pensions. They only rely on the state pension, and I'm guessing the mortality for those members might be slightly different. And as Jeff's saying, it will not be as good as, or the life expectancy will not be as good as for the members of the LGPS.
Yeah, so we do take into account in our analysis the amount of pension somebody has, and that's part of that building up that picture about their socioeconomic status and how much we should adjust that standard table of mortality rates.
Mm-hmm.
Yeah.
This is really interesting. I mean, I know, fortunately, the number of people who work in local government who opt out is quite low. Could you, for example, do a statistical analysis of local government workers as a whole, and those who are in the LGPS and those who, although they're local government workers, so you could try and keep some variables the same there, but opt out of the LGPS, who may, of course, be experiencing financial issues, and that would affect, or is the cohort just not big enough?
It could be that. It could be that. I think, as you rightly pointed out, Chair, the number of people opting out is low, so it might not be statistically kind of viable, but it might just confirm what we kind of like our suspicion.
Yeah, and we don't have, and the administrative authorities of Jeff's team we don't get the data about the people who opt out. Essentially, it's there somewhere. Someone will have it, like the employers will know, but the fund may not have it. So actually gathering the information, the government is keen to gather information about opt out. So it may be something that actually evolves in the future. So yeah, we'll have to watch this space and see what comes out of that, because I think they're quite concerned about people who are not having adequate provision, and that tends to be the people who are opting out because they can't afford it. So yeah, but really good question.
That would be difficult to do, Ian, in that obviously if they remember this scheme, we would track their presence and their health, etc., until they actually die, because there's, you know, we still need to pay their benefits until they die. However, if they opt out, as soon as they leave gainful employment of the authority, you know, we lose track of them. You know, we don't have any record of, you know, as or when or how they die later on, because, you know, we have no need to track that once they've left employment. So unless they are a member of the scheme, we don't have that information to be able to
Yes, I was thinking more of whether it's a matter of working in local government is always correlated with longevity, or whether it's membership of the pension scheme specifically. So people who keep working in local government but periodically opt out. But yeah, I appreciate it may not be statistically significant, and I could just see some headlines along the lines of people who opt in live longer as a bit of a rallying cry for the LGPS, but it's probably an alleyway that we don't want to go down.
Indeed, and it is really difficult because in the LGPS, it's probably got about as wide a range of different occupations as you could have in any pension scheme, because obviously you've got people who work at the council and finance roles and things like that, but you've also got people who sort of collect refuse on the street and people who do cleaning jobs and things like that. So there is all sorts, and they'll have different incomes and have different means and stuff. So yeah, this is kind of the best we can do. We could set an individual assumption for everybody, but that would be spuriously accurate. So we just do an average across the fund. But yeah, it is quite varied, and each LGPS fund is still quite like the assumptions we set for each one is they're quite varied to do with where they live and the different proportions of different roles they have in their fund as well. So it is quite specific to each fund. Yeah.
Yes, and be rather thought-provoking to receive that individual assumption too.
Thank you. Think about it.
Okay, thank you both.
Yeah, my pleasure.
Okay. No problem. So just looking at future improvements, so this is kind of more the industry standard and expectation from the actuarial profession. And the chart shows the improvements in mortality since 1975. So as you can see on the chart, the blue line starting off from 1975 and ending around 2000, the kind of improvements were relatively stable, around 1.8% per year, and then they accelerated, probably with improvement in medicines and quality of life, and that jumped to 3.1% between 2000 and 2010. And then we started to see kind of that improvement shallowing a bit, and the trend kind of going towards the 1%. between the 2010 and 2020. And then, as everyone remembers, we had the COVID pandemic and everything was a bit reset, and we had a bit of a drop in mortality on that year because there was a lot of deaths. So the numbers are slightly skewed towards that. But looking at the last kind of dot in 2024, it looks like that comes back to the kind of 1% trend. And that's kind of the expectation that the life expectancy, the length of life is increasing less than expected before, and therefore our assumptions at this valuation reduce slightly from 1.5% to 1.25%, so small reduction in that expected improvements in the life expectancies. So looking at the numbers in terms of that life expectancy, as you can see on in the table, our expectation is that on average, members will live slightly for a shorter period of time between half a year and 1.3 years. And that plus with resetting the base table has an impact on the liabilities for the fund and reduces it by around 2.5% at this valuation, which improves the funding position of the fund. We've also, as part of our preparation for this valuation, reviewed the other demographic assumptions. And as you can see on the summary on this chart, most of them, the assumptions at the last valuation were still appropriate for this valuation. We only made a small review to the rates of withdrawals from service, so slightly increase it. We think following pandemic, I think pandemic maybe kind of kept people in their jobs, but now the kind of movement between jobs increases. So we've increased slightly the rates of withdrawals and then reduced slightly the pre-mortality assumptions, which again, both of them got very, very negligible impact on the liabilities. And just to talk about other assumptions and adjustment we need to make, or we did make, to the valuation results. So at last valuation, we allowed for the McCloud underpin and the cost of that remedy. At the 2022 valuation, we've done it on a employer level, but in an approximate way. At this time, we've been lucky enough and the fund managed to gather the data in terms of the McCloud remedy for members, and we use the data provided by the fund to calculate this adjustment. And based on the data, there is a small reduction in this adjustment. So again, that slightly improves the funding level. Last valuation, we have not made allowance for the goodwill, which relates to the payment of widowers' pension. This is the equalization of some of those benefits. Because it was very small. At this valuation, we because the results look really good. And I think it's now kind of more embedded that there should be an allowance, and especially employers expect a goodwill allowance in their accounts. We also proposing to make allowance for this in our evaluation, but again, it's very modest, around 0.2% increase in the liabilities. Right, so that's the end of my session and discussions about what's happened since the valuation, and I will pass back to Laura to talk a bit about the funding strategy decisions that the committee will be taking at this valuation, unless there are any questions. No, I can't see any questions. Good, okay, over to you, Laura.
Thank you very much. Brilliant. Yeah, next slide, please, then. We review your funding strategy alongside the work we're doing at each valuation, and then obviously in between the valuations, if something big happens, which means we need to think about it again. For this valuation, there's a change that we needed to reflect, and that is that the Scheme Advisory Board for the LGPS has worked with a number of stakeholders including us, Aon, to develop new guidance for funding strategy. The previous guidance on this was quite out of date. So we've worked with the officers to update your draft funding strategy to be in line with that guidance. The idea is that external readers and employers who have who are looking at this across LGPS funds will be able to compare, because they'll follow a similar sort of structure, and make sure they're talking about explaining that each fund's approach to particular things, so they fund strategies can be compared and contrasted. So most of your previously agreed strategy elements are still in the new draft version. It's just they're all in a different order. And then there's some additional things which set out whether we are going to allow employers to partially exit the fund, and the fund's approach to managing climate change risk and things like that. So this is really just to let you know as pension board, because you'll be interested in whether we're following the regulations and guidance. So yes, we have updated the strategy to follow the guidance, and the committee will there'll be a consultation on this in line with what the guidance says, and then the committee can approve that in due course. And it's obviously part of what we're doing today is to let you know that the valuation calculations will be carried out in line with what the strategy says. Obviously, as a pension board, that'll be something that you're interested in as well. So the key strategics on the next slide, the key elements the committee will be or have already been thinking about when we did this training for them previously for this valuation are, so how much funding risk to take, so that prudence in the discount rate, the probability of funding success, and that's considering your investment strategy. And we're also thinking about the fact that the investment strategy is likely to be reviewed following this valuation. So we just want to make sure that we're working closely with the investment advisors to make sure we're balancing risk and cost to employers. So we think reducing the funding risk now gives you the flexibility to set an appropriate investment strategy without increasing the employer costs. And a key consideration will be how quickly we release surplus to employers through reduced contributions, because as you will see, most employers will be in surplus at this valuation. So it's really important we are fair to employers and give them back through lower contributions some of the gains that have been made, but making sure that in future we're not making it too difficult to increase contributions if things change and things become more expensive, or the position of the fund struggles for whatever reason. So those decisions will be sort of how long a time period we spread surplus to reduce contributions. As most employers are in the fund for a long time, it makes sense to use a long period to do that. And then another consideration is how much surplus to return to employers. Are we targeting a funding position of 100%, or should we target something higher to give them a buffer in case something does go wrong, or allow us to give some of that flexibility around investment strategy and things like that. So we need to think about how confident we are in the surplus that we hold being maintained in the future, so future market conditions, what's going on in the world, and how we deliver stability for employers. We know how difficult it is to ask employers to increase contributions given current budgetary challenges. So that's very much in our minds. And as we talked about, we'll consider how quickly we move to new contribution rates. As we're talking probably about reductions here, we probably won't step them down. There's no point. We probably just go straight to the new contribution rates. Next slide, please, Eric. So just in a little bit more detail, I won't go through everything on here, but if there are employers in deficit, we will target the same end date for getting them back to full funding as we did in 2022. So that ends up being a shorter period to recover than last time. Just because it doesn't look good for the external sort of people looking at the fund if we keep dragging out that date when they're going to get to full funding. So we would target same end date. But we don't expect that to affect many employers, if any. So in 2022, we agreed to only return surplus to employers over and above the 110% level of funding. So if they had a value of assets which was more than 110% of the value of their liabilities, we would return surplus over and above that 110% level. So get them back to 110% funding. And that was because there was a lot of market uncertainty at the time of setting the contributions for the 2022 valuation. There is still a lot of geopolitical tension and non-trivial risk of recession and things like that. So we are proposing to increase that surplus buffer at this valuation. And given we're expecting really significant contribution reductions, which you'll see in a second, this still feels a reasonable thing to do. The other thing is that you don't want to reduce contributions too far below that future service cost we were talking about, because ultimately, after the full period of time of recovering surplus has ended, that is going to be your future cost. So you will have to increase to that point at some, to that level at some point. So you don't want to go too far below that because you'll find it difficult to get back there. So that's the idea behind that. Next slide, please. All right. Conscious of time, there's no change in how we're categorising employers for setting their liabilities in terms of how the risk they pose to the fund and other employers. That employer that we talked about who has no guarantee, we haven't agreed that we'll use a sort of matched position for them, so they can sort of lock in the gains that they've had on their funding position, and then we'll only give them credit for gilts-based returns on their notional assets in future. So it stabilises their position and it makes it more certain, never 100% certain, but more certain that they'll not have a deficit when they leave the fund, and equally not have the fund have to pay out a surplus to them when they do exit as well. So that's the idea behind that. So there's no other changes to employer covenant risk and how we set their assumptions. But Eric, over to you to give the board members an idea of what the results will look like.
Absolutely, yes. And then now it's the slide which everyone was waiting for. So without any further ado, we'll move to it. So as I mentioned at last valuation, based on the probability of funding success of 83.5%, the fund was just over 100% funded with a modest surplus of around 3 million. At this valuation, with the increased probability of funding success to 86, so a bit more prudent assumption, the funding position is at 122%. So quite an improvement, and the surplus is over 600 million. And just to kind of give you a reference point on this slide, we also included the results on a low risk basis. And this basis can be seen as a kind of a cost or the value of the liabilities the fund would have to pay roughly to an insurer to take on all the risks. And that's also really well funded at 115%. So this kind of just gives you a indication of the level of prudence which is included in the funding basis. So it's not as prudent as the kind of buyout basis, the insurer basis, but the basis is quite prudent. It's quite kind of low risk as well, or close to being low risk. Right, what does this mean for before I go to the contribution, I'll just give you the key reasons behind this good position as this valuation. So as you can see on the chart, there are kind of three relatively high or big bars. The first one is the investment profit, and as I said, the fund deliver exceptional returns, and if I'm not mistaken, I think it might be top of the league for the LGPS. So that improved the funding position by around 151 million. The other one is the change in financial assumptions, and this is to do with the increase in the expectation of future returns and a reduction in CPI inflation. Both of these reduce the liabilities, improve the position, and that increased the surplus by just over 338 million. And the other one is the point around the demographic assumptions and the post-retirement mortality and our expectation that members will live for a shorter period of time than assumed before, and that as well improved the funding level by around kind of 90 million. So this is the key reasons for the improvement in the funding level. Right, so moving on to what this means for the contribution. As mentioned at last valuation, the overall the primary rate for the fund was 21.3%. due to the change in the financial and demographic assumptions, the primary rate at this valuation is 16.7%, so quite a reduction. Again, the main reason behind this are the change in financial assumptions, which reduce the rate by around 4.5%, and change in the demographic assumptions, which change the rate by around 0.2%. Right, now putting it all together, and looking at the primary rate, the secondary rate, and the total contribution rate. At last valuation, the primary rate was 21.3%. Secondary contribution across all the employers was averaging at 0%. So the total contribution for the fund was 21.3%. And at this valuation, we're looking at a total contribution rate of 15.8%. And this is composed of the 16.7% for the primary rate and a reduction due to the kind of releasing some of the surplus above the 120%. So the 2% surplus allows to, across all employees, on average, reduce the contribution by around 0.9%, resulting in the 15.8%, which is a reduction in the total contribution across all employers around 55.5%. Any questions? No? Good news?
Sorry, maybe not such good news. Just a question from me.
Yeah.
Just going back to what you said a couple of slides ago, the two main drivers seem to be investment returns and the assumptions made.
Yes.
And obviously both those things are looking forwards. If investment returns aren't as expected, if the assumptions don't pan out as accurately as expected, are you still confident that the employer contribution reduction still provides enough of a safety net?
Yes. So we've kind of discussed this at length with the officers to kind of look at that point. And there is, as we kind of say, there is a lot of fat built around all of the bases. And as compared to this kind of buyout basis, the fund is really well funded. The assumptions are quite prudent. And at the moment, I think maybe Laura will not be happy for me to say that, but I think we might be at that higher point of the prudence. And at next valuation, I think if things pan out as we expect, we will not be looking to increase that prudence even further. At that point, we would start giving the reduction and trying to bring the fund to kind of around 120% funded going forward. But if things start looking not as rosy as we expect, we've got a lot of stuff which we can slightly rein back to kind of like allow us to stabilize that contribution around the 15-16% mark.
Exactly. Yeah, I think that's absolutely right. Because we've increased the prudence this time, but it was fine last time. It's just we've got the ability to do that, to anticipate what you might do with your investment strategy, and then the surplus buffer, we can work with that as well next time if we need to reduce that, if we need to deliver stability. So it's really putting us in a position where we have these levers if we need them next time, and we can slowly start releasing this back. We don't want to just do too much too soon. I think that's the main thing. So yeah, it's a really good question, and it's definitely one we've been pondering about. But yeah.
Okay. And the last question from me for both of you, I think, is I think you're actuaries to a number of funds. How does Swansea at a very high level compare? Are there any areas where we are unusual, whether for good or bad? Funding position, how does that compare? Just a quick, perhaps high level comment from both of you.
Yeah, good question, and one we kind of expected. In terms of the funds that we advise, you're not unusual. I think your good asset performance is a lot better than the other funds. So your funding position is perhaps a bit higher than the average of the funds that we advise because of that, because a lot of other funds haven't had anything like as good performance, and some have had sort of negative compared to our assumptions. So that's really positive. So you shouldn't be ashamed of having a good funding level when part of it is down to your to your assets. But in terms of contribution reductions, then it's similar. Yeah, similar sort of ballpark. I think we've got a range of funds doing different things with surplus buffers. So some are doing what you're doing, some are doing something which is slightly smaller. But pretty much everyone's increasing their prudence this time around because they've got the ability to do so. In terms of other funds out there in the LGPS world, you will see some reported funding levels which are absolutely massive, so 150%, 170%, 200%, and that appears to be because those assumptions are very much linked to what's going on with gilt yields. But I think what you'll see with those is that actually the contributions that come out, because of what they do with keeping them stable and all the assumptions they use for the future, I think they will probably end up quite similar. What we're hearing is that the reductions will probably be not that dissimilar from what you're doing. So I think you can be confident that this will be a sensible approach that will be considered sensible by others and comparable by others. Sorry, Eric, do you want to add anything to that?
No, absolutely. That's the very fair comments. And in terms of the contribution reductions, there will be funds which will see bigger contribution reductions, and there will be funds which will. So there is a range, and I think you're not outlier or any of those measures. But again, we kind of discussed that contribution reduction with the officers and ponder a lot about this and kind of opted for that stability, and then kind of thinking that the reduction of 5.5% is a good reduction, better than expected. So it delivers something to the employers. It also improves the prudence of the fund. So it's kind of good thinking. It's a win-win from both points. And then, as we said, if things pan out as expected at next valuation, then we can just at that point kind of give employers a bit more.
Thank you both. And I did say that was my last question, but Laura mentioned something that triggered a question in me.
Yeah.
You mentioned we've done well with our investment returns. How does our risk level to obtain those returns compare across the funds, the universe?
I think it's probably not the best question for us. It's probably for the investment advisors. They will know more about the risk profile. But from what we understand, the fund is on a path to de-risk the assets and bring a bit more stability into those investments, which again, in terms of the LGPS, you will have a range with very risky investment and very kind of like low risk investments and everything in between. And I don't think you, again, an outlier, you kind of in between, but maybe Jeff can add a bit more to that.
Yeah, so totally correct in your brief response there, Eric. You know, it's long been communicated both to the investment committee, pension fund committee, and the local pension board that we are on a de-risking trajectory as far as the investment strategy is concerned. Only so much as to reflect the demographics within the fund. It is a maturing fund. As we'll talk later on when I present the annual report and the statement of accounts, the fund is cash flow negative now as we speak, and the investment strategy has been amended to reflect that. However, to Laura's point, it is an open scheme. There are new joiners. We are expected to pay liabilities that aren't due for another 40 years. So to be able to meet those liabilities in that time, we do have to still take some investment risk to get the returns that we require. Historically, and as is shown by the graph that Eric put up earlier on, listed equities, both global and domestic, are the way to achieve those returns required to meet those liabilities in the most cost-efficient way. They are admittedly volatile, and there are risks, as you identify there, Ian, associated with investing in those assets. However, as both Laura and Eric indicated, we are trying to mitigate those investment risks by diversifying the portfolio into blah 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 blah. You know, the well-versed communication we've given to yourselves about our portfolio of yielding real assets, which is taking some time, admittedly, to get into the ground and to deliver. You know, just to reiterate Laura's point, the investment strategy that we have implemented has served us well, both in the last 3 years, but also the last 5, 10, 20 years, as indicated in some of the stats I'll share with you later on. So it has stood us in good stead. But you're quite right. You know, the risk levels inherent in the investment strategy shall be addressed and are being mitigated by the initiatives that we've got in place. What else was I going to say, Ian? Yeah, the investment strategy is subject to review now, post evaluation, as it always is. And there's a paper later on, Chairman, which outlines the process that will be undertaken to undertake that investment strategy review. But I wouldn't suggest it be a huge departure from what we're currently doing, merely tweaking around the edges. And to, you know, to Laura and Eric's point about asset performance generally, yes, you know, those charts that Eric and Laura put up with the graphs with the assets steadily rising to the right-hand side of the charts across all asset classes. Yes, it has been a case of a rising tide raises all ships. But to Laura's point, Swansea's ship has raised higher than the rest, and so it's that relative performance as well that this pension fund committee, the work of the officers here, should be recognised in placing the fund in a healthy position that enables us to give back some of those surpluses to employers, but also, to your point, Chairman, safeguard some of these gains experienced to ensure, you know, future officers in charge of the fund don't have to, you know, wildly increase contributions. Because, you know, I've been here long enough at Swansea to experience you know, funding levels of in the low 70s and commentators expressing opinions about, you know, the existential, you know, being of the LGPS as a funded scheme, as a DB scheme, etc., etc. So to be in this position now, to be able to report a surplus and affordable contribution rates, we want to safeguard that, not only, you know, for the short term, but for the medium and long term. Hence all the very prudent and sensible assumptions adopted by the actuaries at this valuation.
Can I just check that that's the end of the presentation?
We've got a few slides.
We've run out of time.
Yeah, sorry.
Yeah,
so
absolutely.
I'll go quickly through them. So I think the next one is to just kind of talk quickly about the outlook, because obviously when we set the assumptions and everything is at the end of March, and then you rightly pointed that there is a lot of volatility and uncertainty going forward. But at the moment, looking at the performance of assets and how the assumptions might have changed. Oh, sorry, it's not the slide. Talking to the wrong slide. This is just to give you an overview of the contribution for other employers. Sorry, I went ahead of myself. So the previous slide showed you the total contribution for the fund, and as at previous valuation, the range of results for the employers will be different. Every employer is starting from a different position and will end up in a slightly different position at this valuation. But across the board, there's an improvement in the funding positions and reduction in the contribution. And most of the employers will be over 100% funded. It's fairly good news for most of the employers as well. Right, going to the next one. This is, yeah, sorry, Laura.
Carry on. No, we're just going to skip through the final ones, Chair, if
Yeah.
that's all right.
Yeah, so I'll just do this very quickly. This is all about the risks and kind of showing you what might happen if something goes wrong. So it kind of gives you an indication what the funding level might look if, for example, the life expectancy goes back up by 2 years, then there is a bit of a reduction in the funding level. What's happened if the discount rate goes up? But all of this kind of are still above the 100% funding. So even if some of them are quite severe, like equities fall by 25%, the funding level can still kind of withhold that drop, which kind of shows the kind of the resilience and the prudence in the funding basis. Obviously, all of them can happen at the same time, so we need to be cautious. But as we said, we probably got enough prudence in the basis to maintain the contribution going forward.
Can I just check, Eric, if those percentages were post the reduction in employer contributions?
Yeah, it doesn't really, it looks at the past service position, really. Yeah.
So this is just the funding levels, of the fund. And then this can have a different impact on the primary rate. So movement in assets have no impact on the primary rate. Movement in the assumptions will have an impact on the primary rate. And therefore, if the discount rate goes up and inflation, if the discount rate goes down, so we expect less returns on assets and inflation goes up, so the benefits are more expensive, then this translates to an increase in the primary contribution rate as well, yes. So this could be like a double whammy effect. Yeah.
Yeah, exactly. Yeah, they're quite extreme examples, but it just shows you using the 20% buffer is perhaps a good idea at this valuation. Then we'll see where we get to. I really don't have much to say about hot topics because it's really just to make you aware that there is every 3 years the Government Actuaries Department carries out a Section 13 review of all the valuations carried out in England and Wales and Northern Ireland separately, just to make sure that the valuations have been done in line with the regulations, so making sure that the funds are solvent and they've got long-term cost efficiency, but just to check they're not being done inconsistently as well with each other. So that review will happen after we've submitted all our results and in the year that follows the valuation. In the 2022 Section 13 review that Government Actuaries Department carried out, there were no flags raised about the Swansea Fund because everything was being managed well and the results were good. We expect that will be the case when they do the review next time round, based on what we know. We don't know for sure what they're going to do testing on and the calculations they're going to do, but we're pretty confident because of how strong position you're in and the fact that you are reducing contributions to employers in a reasonable way. We think you'll be in a good place. We don't expect you to flag on anything. So that's just, as a pension board, I think it's useful for you to be aware of that review going on after we've submitted the valuation and signed it off. But we don't expect that there'll be any red flags or amber flags or white flags or any kind of flags, because they're all different kinds of flags for different things. And then just a couple of other things that are going on, but they're not, we don't need to go into any kind of detail. It's just there's potential changes to benefits which won't really affect the valuation numbers that we're doing this time. But we will be reporting on gender pensions gap in the valuation report. I've already sort of looked at it for your fund for 2022, so we can kind of compare our results with that. But it is going to be quite an interesting metric and useful for future education pieces for your membership. So that's something that we'll be doing because we're expected to at this valuation. And that was all I wanted to say, really, just to make you aware of those points. And this is just the timetable. So we'll be taking the results to the committee in November and then to the employers as well in their employer meetings. So we carry out those on the annual employer meeting day. And then, just getting all the calculations finished, signed off, and then get the valuation report done by the statutory deadline of 31st of March. And that's us. So I'm sorry it took a little bit longer than we promised, but it was because we had such good questions from you, Chair. So thank you for that, and I'm happy to take other questions, but happy to disappear given you've got a wider agenda to get through as well.
Well, I think this is one of the most important items on our agenda, and we're very happy to give you the time that you need to give us the information that we need. Are there any further questions from anybody? I can't. Oh, Jeff.
Um, Thank you, Chairman. Not a question. I just want to place on record my thanks to Laura and Eric, because we're in a very lucky position to be receiving this training and our headline results at this stage of the valuation process, because I know lots of other admin authorities are yet to report and be at this stage. It's because of the advanced preparatory work that both Eric and Laura have done with my colleagues, Claire Elliott and Nick Jenkins and Karen on my right here in preparing for the trial evaluation. And my thanks go out to Eric and Laura for turning that information around quickly and providing us with this information, because we have had initial conversations with our two largest employers, Swansea Council and Neath Port Talbot Council, to give them the indicative direction of travel as a result of this valuation, and that has been much appreciated for the early heads up in respect of that. So I'd like to thank Laura and Eric for that.
Yes, absolutely. I think on behalf of the board, I'd like to thank you both for talking live to your presentation and for answering the questions that we've had. So thank you all very much indeed. And thank you to those Swansea staff who've been involved in the valuation as well. Thank you, Laura, Eric.
Thank you.
Thank you, Chair. And before I disappear, we wouldn't be able to do it if the officers that Jeff mentioned hadn't given us the data as early as they did. And they have won the race again for all the LGPS funds that we advised. They got the data to us quickest. So well done again to that team.
Oh, excellent.
And, yeah, so that's a nice little sort of way to finish. And we'll if you're happy, we'll disappear and leave you to it, Chair.
Yeah, most certainly. Until the next time we see you. Thank you very much.
Brilliant. Thank you very much. Bye, everybody.
Thank you. Bye-bye.
Thank you. Bye. Jeff, would you be able to pass on to the staff the thanks from ourselves and from Aon, but also the news that they are record-breaking in their response times?
No, yeah, I'm happy to do so, Ian. Yeah. Yeah, all that whip cracking pays off in the end.
We didn't hear that. Thank you. So now it is the breaches report. Over to you, Jeff.
Thank you, Chairman. I don't know if you managed to read the report. Obviously,
yes,
you're well used to receiving it.
News. Yes.
Nothing to add, Chairman. Nothing to report.
Yes. Excellent. That in particular, that the employers seem to have got the message that your staff have been giving to them, that there's no late contributions this time. Any questions? No. So moving on to the draft annual report, which has come round again. Jeff.
Thank you, Chairman. Yes, you're quite right. It has come round again, Chairman. Obviously, this is the the banner event as far as the reporting cycle of the pension fund is concerned. It's a statutory document that we're required to produce for Scheme Advisory Board, the pensions regulator, and auditors, to give a snapshot of the financial health of the pension fund. Again, I'd like to place on record my thanks to Karen Cobb, who was largely responsible for compiling and completing this document. You'll recall you received a report at your last meeting of the audit brief, the audit Wales and their audit plan of the audit work they intended to do on this document. They've received this document and are currently busy auditing it and raising audit queries, both with Karen and the rest of the team, about the numbers contained within this document. Not intending to go through it in detail, Chairman, but I will, as in honoured fashion, draw your attention to certain elements and certain pages of the annual report. So if I could ask you to turn to page 41 of your pack, or page 3 of the annual report itself, we've got the usual 3-year profile of stats of the fund. And as you can see, they're halfway down the page. The very pleasing figures of growing asset values from 22-23 at just under 3 billion. Now at the end of 24-25, we sit very proudly at just under £3.5 billion. In terms of members, and what do I mean by members? So I mean active people who are still working and paying into the scheme, so they're contributors. Number of pensioners, people who are enjoying and drawing down their pensions and spending it. And then the people who have previously been members of the scheme, but who have now left the employment of an LGPS employer and are waiting to draw down their pensions. And they're the deferred members at the bottom of that page on page 41 and page 3. And you can see as you read across those, especially in respect to the top number, you can see there a slight decline in the number of contributors, i.e., for the first time, and to Chairman's points he's made previously, a contraction in the membership of the scheme. And as you can see there, an increase in the number of pensioners. So as those people as those numbers fall, it's as a result of people migrating from active membership to pensioner membership. And I'll talk a bit more briefly about the implications of those numbers later on when we come to the fund account. If I could ask you then, Chairman, to turn to page 78 of your pack, or page 40 of the report itself. Again, Laura alluded to the Scheme Advisory Board work in updating funding strategy statement guidance. Well, also they've updated the guidance associated with annual report guidance, and we are required now to report on the work of local pension board. I know we've been doing it now for a number of years as a fund ourselves. However, now it's become a regulatory requirement as a result of the new guidance. And as you can see on page 78 and 40 and 79 and 41, a summary of the meetings that have taken place, who's chaired them, the training that you've received, etc. On page 82 of your pack and page 44 of the report commences a quite lengthy section outlining governance arrangements within the authority. Obviously, Swansea Council is the admin authority of the fund. We largely leverage on the governance arrangements which are in place in Swansea Council, and those subsequent pages outline the governance arrangements in place there. And then, Chairman, if I ask you to turn to page 126 of the pack, or page 88 of the actual report itself, we come to the guts of the statement of accounts itself, i.e. the financial statements. So as you can see on page 126, there's been an increase in fund value during the year of £153 million. As I say, that results in a net asset position of just under £3.5 billion. And as alluded to by Laura and Eric earlier on, that's largely as a result of Swansea's investment returns, and there was some reference to those investment returns being league table topping. And I did share this slide with committee when I presented to them 2 weeks ago, so I'm happy to share it with board as well, which is a snapshot, a page, an extract from the PERC local government pension funds performance statistics universe, whereby all the LGPS funds return and report their investment performance, not only in the year, but over 3 years, 5 years, 10 years, 20 years, and 30 years. So here is the report's author commenting on the longer term performance of Swansea as a fund. So as you can see, the fund has delivered top quartile relative performance over the longer term. Overall shorter term periods, the fund is never ranked lower than 4th percentile and is the best performing fund over the 5-year period and the second best over the last 3 years. An excellent outcome. So basically, over the 3-year period, we're ranked 3rd. Over the 5-year period, we're ranked 1st. Over 10 years, 2nd. And over 20 years, 4th. So those are pretty healthy, near-term and short-term investment numbers. I'll ignore the 30-year figure if you don't mind, Chairman, because that's before my time with the fund. But even then, that 30-year number is pretty healthy at the 14th percentile figure. And just to put into perspective, we are a sort of below average size fund. So we're definitely punching above our weight in terms of investment returns and investment performance. I'll stop sharing that, Chairman, and go back to the figures on page 126 and 88. I did allude to this earlier on, board members. On page 127, you can see there halfway down the page, 2 negative figures there for net additions from dealing with members, minus 14 million for this year and minus 12 million for last year. That figure is telling me as an accountant we are cash flow negative in dealing with our members. So basically, we're paying more out in benefits and pensions and refunds and transfer out than receiving in terms of contributions from employers and members and other income coming in. But luckily, we have the net increase in fund value at the bottom there of £153 million of additional investment return to offset that. So for the first time now, as a fund, we are relying on investment income to meet our ongoing liabilities of the scheme. And that's important, to your point, Chairman, about the shift in investment strategy. I've just alluded to the great investment performance that we've experienced during the last 20 years or so, but that's because we were overtly and explicitly going out to maximise that investment return, to close the funding gap and attain full funding. But we're going to be de-risking the strategy now, taking some of that risk off the table. So we cannot expect to be top of the investment charts going forward because we're not taking as much investment risk going forward. And to address this point here, Chairman, we are investing in more assets which have investment income as the major component of investment return. So what do I mean by that? Investing in more asset classes which throw off cash as a result of their of their investment characteristics. Things like property, things like infrastructure, things like private debt, which pay coupons. So all these investments throw off cash in various forms to help address that cash flow negativity that you can see on page 127 there. The rest of the report then, Chairman, goes through slicing and dicing the figures into more detail and then goes through into identifying the different areas of risk, etc. And again, as a revision to the annual report guidance, we're now required to report on performance indicators for our pensions admin function, and you can see that in Appendix 6 at the back of the report. Again, that's a new addition to reporting requirements. It does make reference to the Wales Pension Partnership and the ongoing developments in respect of that. However, Chairman, if I could leave that then to the report that we have got specifically about that later on the agenda. Conscious of time, Chairman, happy to take questions.
Thank you very much, Jeff. Any questions from my fellow members? No. But other than to say, Jeff, that it's very pleasing, particularly that slide you shared with us, which seemed to be on screen for quite a lengthy length of time. But yes, and thank you all to the staff that have been involved in making that happen. And I see actually Swansea's investing in staff as well, putting them through qualifications somewhere in the report. Unless there's anything else on that, we can move on to item 7, controls assurance review, and that's you again, Jeff.
Thank you, Chairman. Local pension board members will be forgiven if they didn't sorry, Chairman, I've just been passed a note I need to address. Yes, local pension board members were forgiven for falling asleep whilst reading this report when they previously reviewed it. It is very dry, admittedly. As a result of a formal Audit Wales recommendation a number of years ago, we were asked to, as a good practice measure, it was an area for concern, to share with those charged with governance the controls assurance reviewing regime in our third-party service providers. As you're aware, in the organisations that you used to work with or you currently work with, you very much rely on internal audit and the reports that they produce and the work that they do to provide you with assurance that there are appropriate control measures in place. We very much work with service providers, fund managers, etc., as outlined within the report. And again, we regularly receive their own version of internal audit reports to assess the adequacy of the internal control framework existing there. As you can see, if you've managed to read the report, largely they figure around electronic systems and IT systems and reporting and management systems of that sort. And as you can see from some of the exceptions, etc., they're around, not deleting users who have left the organization, they've still got access, etc. So largely good housekeeping type exceptions, they would be in the main. But as you can see, we've included in full the 2 internal audit reports in respect of BlackRock and Russell Investments, because they manage the greater proportion of our investments, over 75% of the investments. And then in reviewing the other controls assurance reports, Chairman, I've asked my colleagues to extract the relevant exceptions which need to be brought to your attention in the appendix there. But as I say, in totality, there's nothing to be concerned in respect of the exception reported or the subsequent management action agreed and implemented to address the exception raised. Happy to take questions, Chairman.
Thank you very much for that, Jeff. I don't have any questions. Are there any questions from my fellow board members? I've just noticed that we only have we don't have an employer rep on the board at the moment, so technically we're not quorate. I think it's just a short telephone call that has resulted in this. Perhaps we could take Jeremy. Perhaps we could take a 5-minute break.
Yes, I think that'd be best, Chair. Just to adjourn and see if Simon can be contacted to see how long he's likely to be away.
Yes. Can I rely on you to do that?
Okay, yeah, we can do that.
Thank you very much.
Okay.
So if we come back at 11:45 to review where we are.
Yeah, that's fine. Thank you, Chair.
Thank you, everyone. Have we got any updates?
Yeah, no, sorry, we can't get hold of Councillor Noyle. So
okay. We're not being recorded at present, are we? As we're in query.
yes, it is. It is. It is
Oh,
running. It is running.
okay.
So yeah, I'll because it was a short adjournment, so I left it
Yes.
running. So
Yes.
I can stop if you prefer, but it'll
well,
run into.
I think technically we're not
No.
a board meeting now, are we? That we're
No,
in query,
that's
so
correct.
you could stop recording.
Yeah. Okay. As it's in court, so that's the end of it. The end of the meeting, basically.
I was just thinking about giving Councillor